Good day, ma'am. My name is Analou Cardinas from BA Stream 3A. I'm going to report Insurance Law, Chapter 14. There are products that satisfy the protection and investment need of the market. Learning objectives: enumerate items that can be insured by a tourism establishment, identify the rationale behind the concept of insurance, explain the different kinds of insurance, identify the advantage and disadvantage of having insurance. Topic outline: introduction, definition and concept, insurable interest in group insurance, insurable interest in property, beneficiaries, fire, marine and third-party liabilities insurance, fire insurance, compulsory motor vehicle liability insurance, war rest insurance, and conclusion. Insurance is very useful for companies engaged in the tourism industry because there are many kinds of risks in enterprises where investment oftentimes is quite substantial. By the way of example, an employer may subscribe to a group insurance of its employees as part of its employee benefit program. Companies utilizing building structures for the operation of their hotels, restaurants, and other tourism-related establishments may think of investing in property insurance against fire or earthquake to protect their investment. Lastly, an investment in marine insurance, an usual practice among companies engaged in the transportation of cargoes at sea, may also be worth looking at insurance code number referred to as PD 1460. In case of the latter's deficiency, the provisions insurance contracts are governed by the insurance law, PD 612, which Institute Civil Code of the Philippines govern. So it explained that insurance is important in tourism industry because it helps protect business from various risks. For example, companies can provide group insurance for employees as part of their benefits. Business like hotels and restaurants may get property insurance to cover damages from fire or earthquakes. Those involved in sea transport can consider marine insurance for their cargo. This type of insurance are guided by the insurance code PD 1460, and if not covered, the Civil Code of the Philippines applies. The next is definition and concept. The law, Section 2. A contract of insurance is an agreement whereby one undertakes for a consideration to indemnify another against loss, damage, or liability arising from an unknown or a contingent event. It explained that a contract of insurance is a legal agreement where one party promises to compensate another for losses or damaged in exchange of payment. These protections apply to unexpected events. For example, a hotel buys fire insurance. If a fire damages the property, the insurance company will pay for the repair cost, helping the hotel recover financially. Discussion of the law. The essential elements of an insurance contract are insurable interest, existence of risk, assumptions of risk by the insurer, said assumptions being part of general scheme to distribute actual losses among those bearing similar risk, payment of premium. The characteristics of an insurance contract are auditory. There is an element of risk. An auditory contract is one of where the obligations depends upon the occurrence of an uncertain event, as in the case of fire insurance, or one certain to happen but at an indeterminate time. The example is death in life insurance. B. Contract of indemnity. There is an exchange of value for value, particularly in property insurance. Letter C. Onerous. There is an invaluable consideration given payment of premium. Letter D. Bilateral. Both parties are bound to do something. Letter A. Formal. As to form, a policy is required to be issued and the premium must be paid. The next is the parties in an insurance contract are insurer, a person, partnership, association, or corporations duly authorized to transact an insurance business. B. Insured, a person with an insurable interest who stands to benefits from a policy of insurance. In its strict sense, the insured party is the owner or purchaser of the policy, even though benefits of the insurance may accrue to someone else. Letter C. Beneficiary, a person designated by the terms of the policy to receive the proceeds of the insurance policy upon the happening of the event insured against. It is the person named in an insurance policy as one to receive proceeds or benefits accruing under. The next is insurance contract. Refer the following: life insurance, an insurance of human lives, and insurance of appertaining thereto or connected therewith. Fire insurance, which includes loss by fire, lightning, windstorms, tornado, or earthquakes, and other allied risks, such risks are covered by extension to fire insurance policies or under separate policies. Letter C. Marine insurance, a contract whereby one of four consideration occurs to indemnify another for loss or damage or on a certain interest subject to marine risk by certain parts of the sea or specified casualties during a voyage or fixed period. Letter D. Personal accident insurance, an insurance which provides pecuniary compensation for expenses or losses of income brought about by death or bodily injury arising from violent external, visible, and accidental means. An insurance contract is considered a contract of adhesion in which almost all provisions have been drafted only by one party, usually the insurance company. The only participation of the other party is the signing of his signature for his adhesion. In this regard, such contracts are to be construed liberally in favor of the insured and strictly against the insurer in resolving all ambiguities against the latter. It explained that an insurance contract is called a contract of adhesion because it is usually written solely by the insurance company. The insured person does not negotiate the terms, they simply agree to signing the contract. Because of this imbalance, any unclear terms in the contract are interpreted in favor of the insured and against the insurer. For example, if a car insurance policy has vague wording about whether flood damage is covered and the insured experiences flood damage, the court may interpret the ambiguity in favor of the insured and require the insurance company to pay for the damage. So the next is insurable interest law. Section 10. Every person has an insurable interest in a life and health of any person on whom he depends wholly or in part of education or support, or in whom he has a pecuniary interest. B. Of any person under legal obligation to him for the payment of money or respecting property or services of which death or illness may delay or prevent the performance. Section 10 explained that the insurance code states a person has an insurable interest in the life and health of someone when their continued life or well-being brings benefits to that person, or the other death or illness would cause a loss. This means you can take out an insurance policy on someone if their life or health directly affects you, financially, emotionally, or legally. So for example, a wife has an insurable interest in her husband's life because his death would emotionally and financially affect her, so she can take out a life insurance policy on him. Similarly, a business partner can insure their co-partner because the business might suffer if the partner dies. Now we have Section 13. Every interest in property, whether real or personal, or any relation thereto, or liability in respect thereof, of such nature that contemplated peril might directly indemnify the insured, is an insurable interest. It explained that Section 3 means that a person has an insurable interest in property if they would suffer a direct financial loss or damage if that person is harmed or destroyed. This applies to both real property like land or buildings and personal property like cars or equipment. So for example, if you own a house, you have an insurable interest in it because if it burns down, you would suffer a financial loss. Likewise, if you rent a space and have equipment inside, you can insure that equipment, since it's lost, you would directly affect you. So we have here Section 14. An insurable interest in property may consist in A. An existing interest, B. Inhocate interest founded on an existing interest. C. An expectancy coupled with the existing interest that out of which is the expectancy arises. So section 14 explained that the types of insurable interest in property, which can be an existing interest, current ownership, or legal rights to the property. It's equate interest, a future or a developing right based on the present interest. C. An expectancy, a future benefits are expected to arise from a current relationship or right. For example, A person who owns a car has an existing interest and can insure it. B. A person who is buying a house on installment has an equate interest and can insure it. C. An heir expecting to inherit a family home has an expectancy based on their relationship with the current owner. So we have here section 15. A courier or depository of any kind has an insurable interest in a thing held by him as such to the extent of his liability but not to exceed the value thereof. Explanation of section 15, that a courier like a shipping company or a depository like a warehouse or storage facility has an insurable interest in terms in the items they are holding or transporting. They can insure those items but only up to the amount they would be liable for if the items are lost or damaged, not beyond the actual value of the goods. For example, a delivery company transporting electronics with a worth 500,000 can insure the items up to the amount they would be responsible for if something goes wrong, say 300,000, not full value, unless they are liable for the entire amount. The next is insurable interest in group insurance. Any person so related to another, either by contract or commercial relation, may lawfully procure insurance on the other's life. Thus, an employer may insure the life of employee and vice versa. The primary aim of group insurance is to provide the employer with a means of procuring insurance protection for his employees and their families at the lowest possible cost, and in so doing, the employer creates goodwill with his employees, enables the employees to carry a larger amount of insurance, and help to attract and hold a permanent class of employees. A group insurance is a single insurance contract that provides coverage for many individuals. It provides life or health insurance coverage for the employees of the employer. In order to validly claim benefits from the group insurance, employment must be actively at work and must have completed a specified period of continuous employment. Otherwise, the insurable interest ceases. Generally, group insurance have non-failure clauses, except for terms insurance provides protection for a limited period, 5, 10, 15 years. If an employee's group insurance terminates because he leaves the employer, the employee has the privilege of converting the group insurance which 1 month following the termination of employment into any standards for the insurance except of a term insurance. It explained that group insurance is a single policy that provides life or health coverage to a group, usually employees of a company. Employers can insure employees because of their business relationship. This insurance helps protect employees and their families at low cost. It creates goodwill and helps retain staff. To claim benefits, employees must be actively working and have served for a certain time. If they leave the job, they can convert the policy into an individual one, except of its terms insurance. For example, Maria works at XYZ company and is covered under their group life insurance. After 3 years, she resigns. She has 30 days to convert her group insurance into a personal insurance policy, unless it was a term insurance plan. The next is insurable interest in property. In property insurance, it is important that insurable interest must exist when the insurance takes effect and when the loss occurs. In marine insurance, the owner of ship has in all cases an insurable interest in it, even when it has been chartered by one who covenants to pay him its value in case of loss, provided that in case of the insurer shall be liable for only the part of the loss which the insured cannot recover from the charter. The measure of an insurable interest in property is the extent to which the insured might be indemnified by loss or injury thereof to any contract of property insurance that gives to the insured more than the indemnity against actual loss that may be suffered by reason of designated perils if is a policy which is contrary to law. So the next is beneficiary. The law, Section 18. No contract or policy of insurance on property shall be enforceable except for the benefit of some person having an insurable interest in the property insured. Section 19. An interest in property insured must exist when the insurance takes effect and when the loss occurs but need to not exist in the meantime. The interest in the life or health of a person insured must exist when the insurance takes effect, but need not exist thereafter or when the loss occurs. So the next is fire, marine, and third-party liability insurance. Insurance, Section 99. Marine insurance includes: Number 1. Insurance against loss of or damage to A. Vessels, craft, aircraft, vehicles, goods, freight, cargoes, merchandise, effect, disbursement, profits, money, securities, shoes in actions, evidences of debts, valuable papers, bottomry, and respondentia, interest, and all other kinds of property and interest therein in respect to pertaining to or in connection with any and all risks or periods of navigation, transit or transportation, or while being assembled, packed, crafted, built, compressed, or similarly prepared for shipment, or while awaiting shipment, or during any delay, storage, transshipment, or the shipment incident thereto, including war rest, marine builders rest, and all personal property floaters rest. The personal or property in connection with or pertaining to a maritime and land, marine, transit, or transportation insurance, including liability for loss or damage arising out of or in connection with the transactions, repair, operations, maintenance, or use of, nor insurance against loss by reason of bodily injury to any person arising out of ownership, maintenance, or use of automobiles. Letter C. Precious stones, jewels, jewelry, precious metals, whether in the course of transportation or otherwise. Letter D. Bridges, tunnels, and other instrumentalities of transportation and communication, excluding buildings, their furniture and furnishings, fixed contacts, and supplies held in storage, piers, wharves, docks, and slips, and other aids to navigation and transportation, including dry docks and marine railways, dams, and appurtenant facilities for the control of waterways. Number 2. Marine protection and indemnity insurance, meaning insurance against or against legal liability of the insured for loss, damage, or expense incidents to ownership, operation, chartering, maintenance, use, repair, or of constructions of any vessels, craft, or instrumentally in use in oceans or inland waterways, including liability of the insured for personal injury, illness, or death, or loss of or damage to the property of another person. So the next is fire insurance. The law, Section 167, and use in this code the term fire insurance shall include insurance against loss by fire, lightning, windstorm, tornado, or earthquakes, and other allied arrests when such risks are covered by extensions of fire insurance policies or under separate policies. So it explained that Section 167 defines fire insurance as not just protect against fire but also against other related risks like lightning, windstorms, tornadoes, earthquakes, and similar dangers. These risks can be included in a fire insurance policy through additional coverage or through separate policies. For example, if you buy fire insurance for your house and choose to include coverage for the earthquakes and typhoons, then any damage caused by those events will also be covered under your policy. For instance, if a strong typhoon damages your roof, the insurance can help pay for the repairs. So the next is compulsory motor vehicle liability insurance law, Section 373. For purposes of this chapter, a motor vehicle is any vehicle as defined in Section 3, Paragraph Republic Act numbered 4136, otherwise known as the Land Transportation and Traffic Code, as amended by PD 1455. B. Passenger. If any fare-paying person being transported and conveyed in and by a motor vehicle for transportation of passengers for compensation, including persons expressly authorized by law the vehicle operator for his agents to ride without fare, as amended by PD 1455. So, letter C, third party, is any person other than a passenger as defined in this section and shall also exclude a member of the household or member of a family within the second degree of consanguinity or affinity of a motor vehicle's owners or land transportation operator as likewise defined herein, or his employee in respect to death or bodily injury arising out of and in the course of employment, as amended by PD 1814. Letter D, land transportation operator, means the owner of motor vehicles for transportations of passenger for compensation, including school buses, as amended by PD 1455. Letter A, insurance policy or policy refers to a contract of insurance against passengers and third-party liability for death and bodily injuries arising from motor vehicles accidents, as amended by PD 1814. The next is section 374. It shall be lawful for any land transportation operator to operate the same in a public highways unless there is a force in relation there to a policy of insurance of guarantee in a cash or surely bound issued in accordance with the provisions of the chapter to indemnify the death, body injury, and or damage to property of a third party or passenger, as the case may be arising from the use of thereof, as amended by PD number 1455. Section 374. This section makes it illegal for any land transportation operator to use their vehicle on public highways without having an active insurance policy, surety, bond, or cash deposit. The insurance or bond is meant to cover liabilities arising from the vehicle's use, specifically related to third-party injuries, death, or property damage. So next is section 377. Every land transportation operator and every owner of a motor vehicle shall, before applying for the registration or renewal of registration of any motor vehicle at his option, either secure an insurance policy or surety bond issued by an insurance company authorized by the commissioner, or make a cash deposit in such amount as herein required is limit of liability for purposes specified in section 374. Section 377 explained that before applying for the registration or renewal for a motor vehicle, land transportation operators or vehicle owners must secure an insurance policy or surely bond or make a cash deposit. This ensures financial coverage for liabilities as specified in section 374. The insurance of deposit amounts must meet the required limits for coverage. The next is war risk insurance. The law. War risk insurance is an insurance covering damage caused by acts of war. It includes coverage for war, hijacking, and related perils. Insurers have intended to withdraw liability coverage for weapons of mass destruction, so WMD. A subset for war risk insurance. WMD includes radioactive contamination, dirty bombs, electromagnetic pulse devices, chemical, biological weapons. Coverage was subsequently provided by full policy limits for passengers liability, but limited to a maximum of millions dollars for all third-party injury and property damage. According to Cicero, the safety of the people shall be the highest law. So for the conclusion, this chapter 14 of insurance law explains how important insurance for helping people and businesses manage financial risk. It discusses the main ideas of insurance such as insurable interest, fairness, trust, and compensation. The chapter also talks about the legal rules that control insurance contract. It is important for both an insured and the insurer to follow their responsibilities to ensure fairness. Understanding these rules helps protect everyone involved and builds trust in the insurance system. The chapter also explains the needs for the clear communication and the honesty between the insurer and the insured. Both must share all important information to avoid problems with claims. It also talks about how insurance policies cover specific risk. both sides should know the terms of the contract to avoid confusion. Lastly, the chapter highlights the insurance laws protect both the insurance company and the policyholder, making sure that the claims are dealt with fairly. Following these laws helps provide financial security and protection for everyone. And that would be all. Thank you.